the common feature for whole life. So for this slide, we're going to talk about the type of the whole life policy, non-par and also participant policy. So in the previous slide, I also did discuss a little bit. So for non-par policy is very straightforward. There's been this kind of policy, the insured amount is payable upon the occurrence of two key elements. There's a death and total permanent disability. So in the unfortunate event for the insured passing away or experience total permanent disability, the policy, they will provide a payout equivalent to the specific insured amount. Across this kind of payout, they will it serves as a crucial financial cushion for the beneficiary of the insured in case of disability. So for the par policy, is another landscape change when we divide into par policy, because this policy additional from the payout upon the death or total permanent disability, and alongside the insured amount, this kind of policy they may offering some so-called potential, some extra bonus or dividend. Across all the additional bonus or dividend, they are not guaranteed. They are not guaranteed, or very subjected to the company financial performance, and particularly in terms of saving from the mortality, expenses, and investment return. Okay, so for the next slide. Okay, so now we look at the graph here. Basically, hopefully the graph will give you the better idea that how you work for the non-par contract and also participant contract. So as you see for the first chart, for the non-par policy, it does not participate in the company profit. There's been the only payout for the death and also death and total permanent disability, the insured amount. So whereby for the participant policy, when it comes to the claim, the participant policy, because they have the advantage to participate the company profit in the form bonus dividend. So there's been upon the claim, apart from the basic sum assured designated amount, this kind of the beneficiary, they also can enjoy the company surplus, okay, for the bonus and dividend. Okay, so now we look at the next slide. So the next slide is a whole life policy. For this graph, we can easily look at the whole life. Basically, we can divide into the three types: the originally whole life policy, the limited the whole life policy, and also whole life endowment policy. So in later part, we're going to be expanding more detail there what are differential among the three. So you look at the whole life insurance policy. There's been the sum assured is payable upon death of total permanent disability. So the payment or the premium, we have to pay until the policy matured. So this kind of policy, they can be participant policy, they also can be the non-participant policy. So, but as long as we want to enjoy the coverage, we have to continue make the premium. Okay, so the next slide we talk about limited payment of the whole life policy. So there's been this kind of policy, the sum assured is payable upon death and of total permanent disability. So the premium, they are payable for the limited number of years, but the policy to cover for the whole life protection. So if you look at the graph here, you can see the straightforward, there's been the limited payment, they can pay maybe some of 5 years, 10 years, 20 years. There's been a specific term dedicated, there's been upon inception of the policy. So the insured coverage amount, they can cover you up to the whole life. So this kind of policy, they also can be the participate or non-participate. But more important is for this kind of policy in the market, they may have some guarantee cash payment over the period. I think this one have to depend on the product features, for the insured company. Okay, so the next slide, because when it comes to life insurance policy, over the period, our client or our prospect, they have more and more expectation. So in the market, they have the whole life endowment policy. This kind of policy, the sum assured is payable upon death and total permanent disability. So apart from the coverage, so our policy owner, they also expected they can receive some type of guaranteed cash payment is payable in a specific certain policy term. So the policy owner, they can have the option to withdraw out the guaranteed cash payment of deposit back the cash payment into the policy. So usually for this kind of policy, they issue the contract is under no par policy. Okay, so after we discussing all about the whole life, now we change the topic on the next slide is the another policy, endowment policy. So today we're going to discuss a little bit another policy, endowment policy. And this endowment policy is stand between the saving and also protection. There's been the offering to cater for some specific purpose. So let us look at endowment policy. So endowment policy basically, in general, we know that is a financial instrument. They combine the element of saving and combine element of saving and also protection. So unlike some other policy, they operate within the specific term. This means normally they would offer the coverage for whole life. So the coverage term, they can be the specific term, maybe 10 years, 20 years, or 30 years. So for this kind of policy, first thing first, they offer some so-called standard value to the policy owner after the 3 years. So understanding the standard value is a crucial, because we know that they can provide the policy owner with a degree of flexibility in managing their policy. So for this kind of endowment policy, to ensure the payment of the total sum assured under two specific circumstances upon death or total permanent disability of the insured upon reaching the maturity of the policy. So for this kind of function, they underscore the policy into twofold nature. This means they're providing the financial protection during the coverage term, and they also offer the lump sum payout upon maturity. This means 2 in 1. This means within the term period, they offer the coverage upon the policy mature. If nothing happens, at least the policy they still can offer some lump sum, so-called the saving payout to the policy owner. Okay, so the next slide we look at the more features for the endowment policy. So as we know, endowment policy, they stand is kind of hybrid, combine the so-called the saving and the protection together. So one of very so-called features, significant feature, I can say significant feature for endowment policy is they're offering the payout structure. So there's been the payout structure, they can pay out at the end of the fixed term. There's been the policy after the specific number of term, they say 20 years, they can pay a lump sum. So the policy, when it comes to mature, if you don't have the premature death happen, then you can receive the saving amount accumulated from the policy. So across this kind of policy and policy, normally they will maintain the level premium throughout the term of policy. So this one will be consistently simplify the financial planning for the policy owner. That means we can allowing them to budget effectiveness, allow them to budget effective without worry about the fluctuation of the premium cost over the period. So another key aspect for this policy is they offer the cash value. So the cash value, they can be accessed throughout the surrender of loan, they can offering the policy owner certain degree of liquidation over the period. Okay, so the next slide is endowment policy again. So look at the features. So I think one of the notable characteristic of the endowment policy is the accelerated rate of building out. Okay, they accelerated the rate of building out over the shorter the period compared to the permanent whole life insurance. That means these features, they appear to individuals, they're seeking the faster aspect to accumulate the value within the limited time frame. So for endowment policy, sometimes they also offering some guaranteed cash payment, such as every 3 years, every 5 years, or every 10 years. So this kind of guaranteed cash payment, they serve as a so-called one of features, adding to the layer of the financial flexibility to the policy owner. So of course, for this kind of endowment policy, the policy owner, they always have the right to option, either they can deposit or they can withdraw out the cash payment declared from the policy. But we also have to understand, and also important for us to note that when it comes to endowment policy, they attract the higher premium due to the inclusive of the guaranteed cash payment. However, this kind of features is preferred by many in the market because it ensures the guaranteed sum in the money and adding to the layer of the financial benefit associated with the policy. So endowment policy, they serve as so-called another financial tools because we can use the financial, that's been the endowment policy for certain financial objective in financial goal in life. For example, we can use the endowment policy for the basic income protection. We can use it for the provision of the fund of retirement. We also can use it for the children education fund, and sometimes we also can use endowment policy for the business startup fund. or they can be any financial goal in the plan according to the client objective. Okay, so the next slide, you look at the endowment policy. So as I discussed just now, endowment policy basically the signature feature for endowment, basically the first one, they can divide into participate or non-par policy is available. And the second one, they offer a lump sum maturity benefit upon the policy mature. And lastly, the certain endowment policy, they may offer the guaranteed cash payment payable before the plan matured. So okay, so this one is the three significant feature for endowment policy in short. So the next slide, we look at the two types of endowment policy. So endowment, they can divide into two categories. One is normal endowment, and second is anticipate endowment. So normal endowment is the traditional form of endowment insurance. They provide the lump sum payout upon the policy maturity in the event of the insured death during the coverage term. So the key feature for this kind of so-called normal endowment, the policy holder, they can receive the sum assured either at the end of the predetermined term or upon reaching a specific age. So in the unfortunate event happen for the insured death during the coverage term, the sum assured is paid out to the beneficiary. So normally for the normal endowment is often we choose by the individual. They're looking for the combination of saving and the protection. So this kind of policy, they serve as a disciplined saving vehicle with the added benefit of financial security. So the next one is anticipate endowment. So anticipate endowment policy is designed to provide the periodic benefit during the policy term. So in anticipate of the policy maturity, this type of policy, they offer the unique approach to the combination protection and liquidation. So normally for the policy owner, they receive the period so-called period payout regularly as a specific interval during the policy term. So they're similar to the normal endowment. The sum assured also payable upon the policy maturity in the event of insured death during the coverage period. So for anticipate endowment is very suitable for those individuals. They're seeking to have the guarantee certain cash flow during the policy term. So it's also often to choosing by the financial planning related specific milestone on the goal. So if you look at the next slide here, so you may have the clearer picture that these two so-called the endowment policy one differentiate. So for the normal endowment, very obviously, so the coverage during a specific term and all the so-called the saving, the cash value, we only can withdraw out upon the policy matured. So whereby for the anticipate endowment policy, the policy owner, they can start to withdraw certain cash in terms of guaranteed cash payment, can be dividend during the policy term. Okay, so now we look at the summary because just now we're discussing about the term insurance, whole life endowment. So hopefully this chart can give you the current picture that what are the so-called the differential between these three policies we are discussing. So the summary chart for this one, if you look at the term insurance policy, very obviously, this kind of policy, they are covered, it's been designed for the protection purpose. So whereby for the whole life policy, I think their focus still protection, but they come with certain element of saving. And lastly, for endowment policy, yes, their combination protection and saving, but for the saving part will be major portion. Okay, so the next slide we're going to touch another policy. That is a single premium policy. Actually, in fact, they have the certain policy we can pay single premium. So they have the features. They allow the insured to pay a lump sum premium for the entire duration on the coverage when the moment inception of the policy. So the amount to be paid will be actually determined by the risk, investment, age, and duration of coverage. And this kind of policy is a fully paid insurance. They cover the duration for the plan, and there will be no subsequent premium. This means it's one-time premium only. So the lump sum payment of the premium can be in a very large amount due to the effect of total premium payable. So however, we have to understand the competitive, this means the saving basically can be the motivating factor due to the advanced premium concept and discounting and discounting the effect. So normally for single premium policy, quite common in the market, they can be MLTA, they say mortgage reducing term insurance. There's been the client pay a lump sum, but they can enjoy the coverage for next 20-30 years during the loan tenancy period. Okay, now we look at the next slide. So the next slide, we're going to discussing about mechanism of investment policy. So this one will be another type of policy. And with this graph, hopefully give you the overview picture how investment in policy, how it works and how it's a mechanism. Of course, when our customer, the policy owner, they pay the premium to insurance company. Before there's been the premium, they come into the company, they will divide into two accounts. One will be the allocated premium. So the allocated premium that's been is determined by the insurance company, allocated premium. So the allocated premium, basically they will utilize it, they put into utilize it, become the investment fund. And investment fund, they all become converted into the investment unit. So the cancel unit, they to pay off the service charge, insurance charges, and the remaining value, the account value that belong to the policy owner. So whereby another portion in the right hand side is unallocated premium, and basically unallocated premium is not in the picture anymore because this kind of unallocated premium, they utilize to pay off the commission, the marketing charges for the agent, financial planner and marketing purpose, and also some expenses. They will deduct all the costs from the unallocated premium. So this one is overview, the mechanism of the investment policy. So now we look at the next slide. So when we talk about investment policy, we have to understand what is the investment policy. So basically, investment policy is type of policy. They go beyond the traditional, the whole life policy, because it's a dual purpose instrument. They're providing the book protection and also direct link to the investment performance. So unlike the whole life policy and term policy we discussed just now, all the policy we have to depend on the company performance, whereby for investment policy, all the premium that's been for the investment portion, they go right to the investment, I think mainly on the equity fund management purpose. Okay, so when we talk about investment policy, we have to understand a little bit about some landscaping about life insurance policy for the investment link. So investment link policy actually, in fact, the premium they pay by the policy owner, they serve as the dual function. There's been certain portion they cater for the dedicated for the purchasing the life insurance protection purposes to ensuring the financial security for the insured and also for their family beneficiary. So another portion, basically, this kind of policy they will allocate by the insurance company, managed by the insurance company fund manager to invest into the insurance company fund management unit trust in a sense. So all fund, basically all the fund they represent the diversified. There's been the range of investment option. They can be the equity, they can be the bond, they can be the market, money market instrument, and all the performance of the fund, they're going to influence the value of the policy investment value over the period. So I think when we talk about investment in policy, one of the features is they offer a certain degree of the flexibility and also the transparency, and it's not commonly found in the traditional policy, because for this kind of investment policy, the policy owner, they can often to monitor the performance of their investment linked fund, and also they can providing the clear understanding that how the premium contribute to both potential and also potential return over a period. Okay, now the next slide, we zoom more detail about the investment linked policy, how's the features. So investment linked policy, very obviously, we know that this kind of policy, they're providing the opportunity to accumulate the wealth throughout the participating the investment fund and obtain some protection over the period. So all the premium paid to the insurance company is for the investment linked plan. Basically, they split into two portions. One cater for the fund, cater for the protection, and second part basically cater for the investment over to get the return. So the policy owner undertake to pay either the single premium. There's been this kind of policy, they can go for a single premium, or they can go for the regular periodical premium for the investment plan. So the investment fund, they may manage either by the insured, or they can manage by the external fund manager appointed by the insurance company. So the prime aim for the investment policy is to provide the protection and also to enable the policy owner to participate in the investment fund to accumulate their wealth to reach the certain financial goal over the period. So the next slide, of course, when it comes to investment policy, as a policy quite transparent, they also involve some so-called, there will be some show to you some charges involved. So the first charger is policy fee. So it's basically the same as a traditional insurance policy, the policy fee, just that because these they involve some investment, they have some so-called the annual fund management fee incurred. The fee range between the 0.5% to 1.5% every year, depending on chooser by the policy owner. So for this kind of policy, they also have the mortality charges. So there's been this to cover the mortality cost and also and therefore dependent and also on the age. So the next one is surrender charges. These are charges deducted from the value of the unit upon surrender. So it represents the initial expenses which have been already incurred but not yet recovered. So the lastly with partial withdrawal charges, and these charges is incurred per withdrawal, but also very subjected to the policy because different policy they have the different percentage charges, and some yes, some no. So if yes, there is the minimum amount for withdrawal as well, because many policy basically they require the policy owner to keep the minimum fund balance after withdrawal. So some companies they may sooner less than 1,000, some companies say may not less than 500, and some companies say may not less than 3,000, dependent policy. Okay, so the next slide we talk about some feature for investment policy. There is a premium holiday. So premium holiday is a feature that allow the policy owner to waive the payment of the premium for the period of time. So the premium holiday can be taken as long as there are sufficient units to cover the charges under the policy. So the policy will still continue in force during the premium holiday. So however, we have to take note, the policy owner is not advised to take the premium holiday for the long period, because the number of units they will continue to decrease over the period due to the cash out to minus out to cover the cost of insurance. So the policy, they ultimately, if we continue let the premium holiday continue, the policy may have the potential lapse, because when there are insufficient units to meet the cost of insurance, the policy charges, the policy may lapse. So I can say premium holiday basically, if you compare with traditional policy, the advantage is when they utilize it, they did not incur additional interest. But bear in mind, we have to make sure we not to advise our customer take premium holiday for too long. Okay. So the next one, we look at the next slide, some features. Okay, of course, we talk about investment policy. There will come some features that pricing and unique. Because investment policy is an investment portion, and the premium we are going to use to buy some so-called the unit trust unit in the investment fund. So these are unit they are purchasing at the offer price of unit. So the number of unit they own by the policy owner is equal to the premium allocated to the investment divided by the offer price of the unit. So the value of this unit, they are very dependent on the investment performance of the fund over the period. So the policy owner had to bear the risk associated with the policy and to enjoy the potential benefit of the policy. Okay, for this one. So the next slide, we're going to look at the investment policy. Okay, so we know the insured, they may have actually in fact, every company that's been the insured, they may have 2 or more funds available for the policy owner to choose and to invest throughout via their investment policy. So the policy owner, they will choose the fund depending on the risk appetite. So investment policy, they can be very effective saving, and the investment scheme based on the concept, the concept of dollar cost averaging. So normally in the market, the type of fund available, they can be the range for the cash fund, equity fund, bond fund, property fund, special right fund, and diversified fund. So there's been they have the different type of fund available. They have the different type of risk offered to the customer to choose. Okay, via the investment policy. So just now I did mention the next slide is the dollar cost averaging. So basically dollar cost averaging is one of the principles, and we can apply perfectly why use the investment policy. So dollar cost averaging is simplest that's been to understand that it took out the consistent and continued purchasing of the unit. There's been our policy owner of our investor, they will benefit himself or herself for the volatility of the market, because some unit we may bought in the higher prices and some other in lower prices, but average out of the cost of the policy owner investment over the period will be uptrend over the period, right, for this one. So that's why cost averaging, that's when dollar cost averaging will be very powerful features we can apply using the investment policy. So the next one, another features, the next slide is switching. So investment policy, they got one feature called switching. So there's been the investment linked plan, they allow the switching, they allow the policy owners to switching of the unit from one fund to another. So there's been the policy owner, they may, anytime they can switch out the unit from one fund to another depending the fund performance or depending the market situation condition. So in general, the insurer does not charge the fee for the initial switch, but certain provider or certain insurer, they may impose a certain fee for the second or third time switching. So the number of free switch and also corresponding charges for the subsequent switch is very set up very clearly in the policy contract. So if our customer we would like to advise our customer for switching, so we have to look at the charges settled in the contract clearly. So at times, the company may level a charge on each and every switch. So they see maybe the certain policy, they have the limitation of free switching features. Okay. So the next slide, we're going to touch a little bit about top-up premium. Because we know that investment policy, one advantage is they allow the policy owner to top out the premium to purchase the additional unit at any time. Because sometimes we would like to benefit from the volatile market, we want to invest or pumping more money to buy more unit at a lower peak that's been in the low price. So these features is to enable the policy owner to take some advantage on the opportunity in the market. So when the price is low, so they can build out the largest investment value over the period. So top-up features is very powerful feature in the investment policy. Okay, so the next slide is another features. Okay, so I think unlike the traditional policy, I think investment policy they offer a lot of flexibility. One of the features is we call it the full or partial withdrawal. There's been for policy owner, for this kind of policy, the policy owner they have the right of option to withdrawing all or partial unit from the fund. So across the full withdrawal is the full withdrawal with liquidation all the fund from the policy, and liquidation the value based on the unit price at the time of liquidation. So if when the moment we full withdraw out, it can be considered surrender of the policy. So the policy they will seize an asset. But whereby we have the another option is we can do the partial withdrawal. So the partial withdrawal can be made as long as they have we have to make the certain minimum number unit stated in the contract. So any surplus we can take it out due to certain emergency. So the minimum amount also stated in the contract. So sometimes some policy will do the partial withdrawal with no charges, but some policy they have some minimum charges. So we have to understand the contract. But at least when it comes to the partial withdrawal, they can serve as another emergency fund backup for the policy owner when some crisis happen. Okay, now we look at the next slide. So this slide basically is explaining that when it comes to liquidation for the full withdrawal, partial withdrawal, how is the so-called mechanism work. Okay, so for full withdrawal, actually in fact in the market they have the two type of so-called pricing. Either you go for full or partial withdrawal. So some company they practice a single pricing. That means the withdrawal is equivalent to the number unit times the unit price is straightforward. But whereby certain company they are pricing the lower pricing. That means when you purchase the withdrawal, the number unit, that means the big price is different. Okay. Okay, so the next slide. In general, I think for the investment policy, I can say the common feature for the investment policy is normally for investment policy, I think they offer more transparent features compared with the traditional plan. That's why if you compare with the term, compare with the whole life, compare with endowment, I think investment policy are more transparent. So adult, we know that investment return for investment policy is not guaranteed, and it's very subject and depend on the fund performance, okay, from the fund management. So the next slide, the features. So across this slide, I did mention that For investment policy, I think one of the features is they offer the flexibility on the premium. So there's been time to time, we offer some so-called flexibility to the client. They may increase or they may reduce the basic regular premium without changing the insured amount. So of course, this one is subject to the minimum annual premium and maximum minimum insured amount requirement. Okay, so the next slide. So for this policy, also investment policy offer the top-up features. There's been they allowed to purchase additional unit or the investment link fund, which they also be added to the existing unit for the policy owner account. So sometimes the top-up they can be doing in the single top-up. They also can do it in the regular top-up premium. Okay, so this one is to sum up actually in fact for the investment policy. We know the flexibility is not only for the premium. When the premium is unpaid, the policy shall keep in force by effective as long as they apply the premium holiday until the end. When the value becomes zero, policy will lapse. So across the policy also allow some withdrawal features. There's been the customer can withdraw the money in terms of number unit of fixed monetary amount throughout the cancellation unit. So the next slide will be talking about the features of investment policy. There's been the insured amount flexibility. So for investment policy, I think one of very powerful features is when this policy, the policy owner, they may have the option to adjust the basic insured amount and also the rider insured amount without changing the so-called the premium pay too much. So there's been you can adjust the coverage over a period to cater the different financial needs. So the last one will be the switching. There's been they can also switch between the fund by fund provided by the insurance company. So the next slide, I would like to touch a little bit about the investment policy. We know they got two types. First one is a single premium and second one will be the regular premium. So you look at the next graph, I'm going to expanding that. Actually, in fact, for the single premium, we can define as a one-off premium. Contribution is made. There's been always emphasizing the long-term saving in the investment. And whereby for regular premium plan for investment link, the premium are paid at the regular basic. They can pay by monthly, pay by quarterly, half yearly, or yearly. So this kind of plan, they're emphasizing the investment and the life protection 2-in-1. They can cater for 2-in-1. So in general, look at the next slide. We know for investment policy, the benefit, first thing, they're reporting of diversification and they can offer the flexibility in the premium flexibility in the plan for the client time to time. So when we put in the money into the investment policy, they also offer some expertise. This way we can leverage the expertise from the fund manager to grow our money over the period. So we can access to diversify the portfolio, and we do need for the personal administrative to manage our fund. So I think the risk actually, in fact, we also know when it comes to the investment, there's been investment policy, they touch the investment. When it comes to investment, the risk always is volatile in the market. So we know we have to face some return rate risk. There's been, we also have the potential to the risk to lose our capital. Okay, so this one is some risk occur in the investment policy. Okay, now we look at the next slide. So the next slide, actually, in fact, in general, we just want to do some simple comparison because we already discussed the different type of insurance policy, and typically you look at the traditional and also investment link. So for this slide, basically we would like to look at how's the differentiation. So for traditional policy, basically they offer the fixed interest rate. Normally for traditional policy, they offer the fixed interest rate, can be the bonus or dividend declared by the insurance company. So the returns are predictable, but may be lower compared to other investment options. So for traditional policy, they often carry the lower investment risk. They're making them suitable for the conservative investor who priority the safety over the potential higher return. So whereby investment policy, when it comes to the return, they are likely linked to the investment fund. So there's been allowed the policy owner to potentially benefit from the high return associated with all the investment. However, bear in mind, investment policy also come with a higher investment risk since the return they are subject to the market fluctuation. So the policy owner, they may experience both gain of, it can be lost, okay? Can be gain and loss, okay? The next one, if you look at when look at the computation of the premium. So the premium for the traditional policy, they are calculated based on the actuary table. So based on the mortality rate and also the insured guarantee interest rate. So the premium for the traditional policy normally they are relatively can be more stable. They do not have the fluctuation based on the investment performance. But whereby for investment in policy, they compose two parts as we know. So one will be the cost of insurance, in short we call COI, and second one will be the investment portion. So the investment portion of the premium they may vary based on the policy owner choice of investment fund and also the performance of the fund. Whereby the cost of insurance portion also very subjected to the risk of the policy owner, can be the age, can be gender, can be occupation. So if we make the changes of the cost insurance getting higher over the period. So the next part will be the surrender value. Okay, so you look at the traditional policy, we often accumulate the cash value over the time. So the policy owner, they may have the access to the surrender value if they decide to terminate the policy. So whereby for this surrender value, they usually I can say mostly they are guaranteed mostly they're guaranteed. So they may incur some bonus or dividend. But whereby investment policy upon surrender, they may have the cash surrender value, but it can be more variable because due to market fluctuation. So all the surrender value, they really depend on the performance of the choice of investment fund, and they may subject to the market risk. Okay, so the next one will be the option and the topping out. Okay, so for the traditional policy, they often very limited option for the premium top up. So if you want to pay additional premium to increase coverage or cash value, so the top up option, I think generally for traditional policy, it's very straightforward. They may not provide significant flexibility on this part. But when for investment policy, they allow policy owner to make the additional contribution to their investment account. So policy owner also can adjust their investment allocation, switching between the fund, or make the lump sum contribution, or providing the greater flexibility to managing their investment. Okay, so the last thing will be premium holiday. So traditional policy, typically they do not offer premium holiday. So if you mix up the premium, they may apply the APL, auto premium loan, with the interest if you still got a cash value. If not, any missing or premium payment, they may result the policy lack or reduce the benefit. So whereby for investment policy, they offer the premium holiday, allow the policy owner to suspend the premium payment for the specific period without affect the policy benefit. So premium holiday can be provide the financial flexibility during the challenging time. So this slide I just sum out the comparison between the traditional investment link. So with the benefit provided by both policy, don't have the perfect solution. So all depend on the customer need and also what is their expectation on requirement. Okay. So the next slide, we're going to touch a little bit another policy is universal life insurance. Okay, so universal life insurance is quite similar to the investment policy, where the customer account value is invested in the universal life fund, which managed by the insurance company. So for policy owner, we have to look at this kind of policy structure. They provide the unique blend of the insurance coverage and also the investment potential. So the universal life fund actually, in fact, they act as the dynamic investment vehicle. They're allowing the policy to potential to accumulate cash value over the period. However, it's very also essential for policy owner to be aware that if they surrender the policy, surrender the ability to choose the specific fund and must rely on the insurer investment decision. So the creditor interest rate also determined by the insurance company. They reflect the insured financial performance and also the market condition. So this place actually, in fact, is a degree relying on the insurer financial acumen and also underscore the importance of selecting reputable and also reliable insurance provider. So if you want to go for universal life policy. So the next slide, we're going to look at some so-called common feature for universal life policy. And normally for this kind of universal life policy, usually they complement the minimum guarantee features. For example, they may offer you some minimum creditor interest rate of no lapse guarantee features. And for policy owner, the common feature for universal life is adaptability to various financial goals and also the risk tolerance. The minimum character interest rate and also no lag guarantee provided with the safety to ensure that the policy remains robust even the less favorable economic condition. So the flexibility for universal life allow policy owner to tailor the policy to their need. So they can adjust the premium payment, they can adjust the death benefit, they also can adjust the investment component, offering the level customized, not common found in the traditional life policy as well. Okay, so we look at the next. So the next slide, we're going to zoom in some so-called special features for the life policy, general life policy. So the first one is the bonus. So let's start with the bonus, cash bonus. So cash bonus is the features they involve the actual cash payment to the policy owner. When this bonus they are declared, the policy owner they can have the flexibility to receive the cash directly. So it can be the immediate benefit, providing some liquidity to the policy owner. However, the interesting twist is policy owner they also have the option to leave the cash bonus into the policy to the insurance company. So by doing so, they can earn the certain rate of interest of dividend for the amount they deposit to the company. So this dual option allow the policy owner to tailor the benefit of their policy according to their financial need and also preference with this kind of cash bonus. So now we zoom to the second is a divisional bonus. Okay, so for this kind of bonus is a unique add-on. For me, it's a unique add-on to the sum assured of the policy. So unlike cash bonus, so for this kind of divisional bonus, it's not the immediate payout to the policy owner. So instead, they become part of sum assured. That's means they're providing the compounding effect over the period, over the year. So this kind of bonus, they can take the form of the compounding return. That's means the bonus paid in the previous year, they are compound in the subsequent policy year. So this kind of compounding effect, they enhance the overall value of the policy over the period, over the time. So the providing the policy owner with the accumulate the benefit, they grow with the duration of the policy. So for the policy owner, we have to understand both the cash bonus and also divisional bonus, how they can use it essentially making the different so-called decision into our life changes to cater our plan. Okay, so the next slide, we would like to touch this one is another bonus. So this called performance bonus. So performance bonus is a special features they offer by insurance company to reward the policy owner when the company they achieve some essential that's been outperformance return. So this kind of bonus they are testament to the insured investment and also is the operational effectiveness, transparent that's been translate into the better than expected return. Performance bonus. So when the insurance company they outperforms into the certain expectation, a portion of that superior return is allocated to reward both policy owner and shareholder. So this aligns the interest of the policy owner with the overall success and the financial health of the insurance company. So the performance bonus serve as the tangible acknowledgement of the mutually benefit relationship between the insured and the policy owner. So the next one, we zoom to put some attention on the maturity bonus. So maturity bonus are unique form of reward payable for the policy they are maintained until the maturity date. So they either at the end of stated policy term of the insured that's been they reach the specific age. So this kind of bonus they are diffraction of the insured appreciation for the policy owner commitment to keeping the policy in force until the maturity. So the determination of the payment of maturity bonus they are typically on the hand of insured and they are contingent upon the operating performance of the company. Okay, so this slide the last one. The next one, I would like to touch about terminal bonus. So for terminal bonus is an extra bonus payable on a life insurance policy which has been enforced minimum number of year. So the commencement of payment for the terminal bonus often they occur on the specific milestone. So typically after 10 years, 20 years. So depending on the policy condition, and this means the policy owner they be eligible, okay, to receive the additional bonus when the policy reaches a certain duration. So the condition under which the term under the terminal bonus can be paid is various because it's applicable on the policy surrender after the specification minimum number of year. So the calculation and the payment of terminal bonus, they are determined by the insured and they are closely tied out to the operating performance of the insurance company. So unlike the regular bonus that policy owner they receive annually, so whereby terminal bonus there is a calculate based on the percentage of the accumulated annual bonus over the year. So there's been terminal bonus is a unique features align the interest of the policy owner with the overall financial health and also success of the insurance company. The better company perform, the significant the terminal bonus will be lah.